In today's fast-paced financial world, predicting wealth growth isn't just guesswork, it's driven by data. Predictive finance harnesses powerful analytics and machine learning to analyze patterns, market trends, and individual behaviors, giving investors and institutions a clearer view of future financial opportunities. By transforming raw data into actionable forecasts, predictive finance empowers smarter decisions and smarter growth. Let's dive into how data is reshaping the way we foresee and build wealth. Today we will talk about predictive finance, using data to forecast wealth growth. So before we start, make sure to hit the like button and subscribe to my channel. 1. The emergence of predictive finance in a data-driven world. In the digital age, data has become one of the most valuable resources, fundamentally reshaping traditional finance. Predictive finance, a subset of financial technology, leverages massive datasets, artificial intelligence (AI), and machine learning (ML) to forecast future financial trends, behaviors, and wealth trajectories. As businesses, institutions, and individuals increasingly generate vast amounts of financial data, ranging from transaction histories and investment performance to macroeconomic indicators and behavioral patterns, predictive finance transforms this raw data into meaningful insights. The rise of big data and real-time analytics platforms has accelerated this evolution, making it possible to assess risk, forecast asset performance, and even personalize wealth-building strategies with remarkable precision. Predictive finance isn't about replacing human judgment. It's about enhancing decision-making through deep, data-backed foresight. 2. How predictive models work in financial forecasting. At the core of predictive finance lies a variety of statistical models and algorithms designed to identify patterns and predict future outcomes. These models often draw on historical financial data, economic indicators, and even non-traditional data sources, such as social media sentiment or satellite imagery, used, for example, in agricultural finance. Techniques like regression analysis, time series forecasting, and deep learning neural networks allow systems to model relationships between variables and forecast results like investment returns, credit defaults, or retirement savings outcomes. For instance, a machine learning model might analyze a user's spending and saving behavior over time to predict their future net worth or recommend adjustments to maximize wealth growth. The models constantly improve as they ingest new data, learning from past inaccuracies to deliver increasingly accurate forecasts. 3. Applications across personal finance and institutional investing. Predictive finance has applications across the financial spectrum. For individuals, it powers smart budgeting apps, robo-advisors, and personal finance management platforms that forecast cash flow, suggest investment allocations, and even predict financial health years into the future. Platforms like Mint, Wealthfront, and YNAB use predictive algorithms to help users set and achieve financial goals based on income patterns and market conditions. On the institutional side, hedge funds and asset managers rely heavily on predictive analytics for high-frequency trading, portfolio risk assessment, and market timing strategies. Financial institutions also use predictive finance to assess creditworthiness and detect fraud by modeling client behaviors. These tools allow for proactive, rather than reactive financial management, enabling institutions and individuals to anticipate changes and make informed, strategic decisions. 4. The data sources fueling predictive finance. The effectiveness of predictive finance hinges on the quality, variety, and timeliness of the data it processes. Traditional financial data, like earnings reports, credit scores, and interest rates, remains foundational. However, alternative data sources are becoming increasingly influential. For example, transaction data from digital wallets, real-time market sentiment from social media, geolocation data from mobile devices, and even psychographic profiles can feed into predictive models. In investment scenarios, satellite data may be used to assess supply chain activity or agricultural output, influencing commodity price forecasts. Meanwhile, open banking initiatives allow fintech platforms to access customer data from multiple financial institutions securely, creating a holistic financial profile that improves predictive accuracy. The integration of such diverse data sets enriches the models and enables more personalized and relevant financial predictions. 5. Enhancing wealth management through predictive analytics. Wealth managers and financial advisors are increasingly adopting predictive finance tools to deliver tailored services to clients. These tools assess clients' financial behavior, risk tolerance, life goals, and market trends to simulate future wealth scenarios. For example, Predictive retirement planning models can forecast whether a client is on track to meet long-term goals based on savings rates, expected returns, inflation, and healthcare costs. Advisors use scenario analysis and Monte Carlo simulations to model best case, worst case, and most likely outcomes for a range of financial decisions. Predictive finance also aids in tax optimization, estate planning, and dynamic asset allocation, helping clients adjust their strategies in real time as personal circumstances or market conditions change. Ultimately, this data-driven approach fosters trust and confidence between advisors and clients by aligning decisions with long-term outcomes and evidence-based forecasts. 6. The role of artificial intelligence and machine learning. Artificial intelligence, particularly machine learning, is the engine behind modern predictive finance. These technologies allow models to autonomously analyze vast and complex datasets, identify nuanced patterns, and improve over time without human intervention. Deep learning, a branch of AI that mimics the human brain's neural networks, excels in recognizing subtle relationships and adapting to non-linear dynamics common in financial markets. Reinforcement learning algorithms, often used in algorithmic trading, learn optimal strategies through simulated trial and error. Natural language processing (NLP) enables systems to analyze news reports, earnings calls, and social media to gauge market sentiment and project its impact on asset prices. Moreover, AI democratizes financial expertise by embedding intelligent decision-making capabilities into everyday tools and platforms, making sophisticated forecasting accessible to retail investors and small businesses alike. 7. Limitations and ethical considerations of predictive finance. While the benefits of predictive finance are considerable, its limitations and ethical implications warrant attention. Models are only as good as the data they are trained on. Biased or incomplete data can lead to inaccurate forecasts or discriminatory outcomes. For example, predictive lending models might unintentionally reinforce systemic biases if historical data reflects past inequalities. Over-reliance on automated forecasts can also lead to complacency or misjudgment, particularly during unprecedented events like the COVID-19 pandemic or geopolitical crisis, which may not be adequately captured by historical data. Transparency, explainability, and data privacy are critical concerns, especially when sensitive financial decisions are influenced by algorithms. Regulators are increasingly scrutinizing the use of AI in finance, pushing for fair lending practices, model accountability, and user data protection. Striking the right balance between automation and human oversight is essential to ensuring that predictive finance serves the broader goal of equitable and sustainable wealth growth. 8. The future of predictive finance and wealth forecasting. As financial ecosystems become more interconnected and data-rich, the future of predictive finance looks promising and increasingly indispensable. Advancements in quantum computing, real-time analytics, and decentralized finance (DeFi) will further enhance predictive capabilities. Predictive finance may soon incorporate environmental, social, and governance (ESG) metrics to forecast not just financial returns, but holistic wealth outcomes that align with ethical and sustainable goals. Personalized AI financial assistance could become ubiquitous, helping users make day-to-day financial decisions with long-term wealth impacts in mind. Institutions may deploy predictive finance to stress-test economies, predict systemic risks, or guide central banking policies. Ultimately, as predictive finance evolves, it will not just forecast wealth growth. It will redefine how individuals and societies envision and achieve prosperity. The challenge lies in harnessing this power responsibly, ensuring it benefits all participants in the financial landscape. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.